In this video, we're going to go over the top 7 stocks that Jim Cramer believes are a buy right now as the economy transitions back to the normal way of living. With the huge news from the vaccines, we have vaccine from Pfizer showing it's 95% effective. Of course, we have the result from Moderna showing 94% effective, and the newest result came in at over 70% effective. So we have 3 solid vaccine trials, all with great efficiency rates, and these have led to the idea that one day very soon, the economy and the way of life will go back to where it once was. So Cramer put together a list of over 20 companies that he believes are a buy and will see some upside potential as we transition back to normal. And I broke down that list, picked one from each sector of the market, my favorite within each, and we're going to go over those companies and why I believe they could potentially be a buy at this current level with some strong future momentum moving forward. For each of the companies on the list, we're going to take a look at their current share price, the current financial position of the company, and why we see them growing as the economy shifts back to normal, as the vaccine begins to get distributed, and as we can get the pandemic under control. Before we do that, if you're new here everyone, I am the Gen Z Investor, and every single day we talk about the stock market, we go over different stocks you can buy and sell within your own personal portfolios, and we track and follow along with the growth of my personal dividend growth portfolio that currently sits at a value of over $73,000. I post every single day about any major market news and headlines, and in this video, we're going to focus on the 7 companies that could be a potential buy right now with a lot of upside potential as the economy begins to reopen moving forward. So please hit that like button and subscribe to the channel for daily videos about the market, and we're going to jump right into the first stock on this list, which is Visa. Ticker V currently trades at around $213 per share, and they are up a massive 160% over the past 5 years. Even during 2020, shares are up around 16% on the 12-month chart, and they currently trade at a market cap of $434 billion. The company has a forward PE of around 38, and this is a leader in their respective industry. Visa makes up around 60% market share of the credit and debit card market, which is absolutely incredible because I believe this is only going to grow moving forward. And as we return to normal, the travel industry picks up once again, Visa services and Visa products are going to be used much more frequently. And of course, as we transition to more shopping online and less in-person retail, Visa services, Visa credit cards, Visa debit cards are all going to be used to make those digital purchases online, and that market and that demand for those Visa goods, I believe, are continue to expand and they will maintain market leadership in their respective industry. I think there's not many companies that can compete with a Visa in the world, and I think their platform is only going to grow moving forward as we return back to normal. And if we take a look at this company, they currently yield 0.6%, but they only pay out around 23 to 24% of their earnings. So an extremely low payout ratio, and that tiny starting yield grows at a massive rate, averaging over 20% annual dividend growth rate over the past 5 years. So although your starting yield is very low, you're getting a majority of your return from the share price growth, which averages huge numbers each and every year. And of course, the dividend is a slight bonus that is growing rapidly each and every year as well. And if we take a look at their income statement, the company's been expanding at a massive rate. Each and every year, they post top-line revenue growth. Of course, over the past 12 months, we've seen kind of stagnant growth because of the pandemic, but they have insanely high profit margins. Net income for this company averages between 40 and 50% per year. So they bring in a ton of net income, and this is a cash cow company that I believe is only going to expand moving forward. The second stock I chose from Cramer's list was from the aerospace sector, and as travel begins to pick up, that industry is expected to grow as well. And I chose Honeywell, ticker HON, $207 per share right now, up over 15% on the 12-month chart. They currently trade at a market cap of $143 billion with a forward PE of 29. And why I chose this company is that they are not solely reliant on the aerospace sector in order to grow. A lot of companies within that industry were hit extremely hard because of the pandemic and were either forced to shut their doors or significantly reduce their company and their business profile. But what I like about Honeywell is that, of course, one of their business segments is in the aerospace sector, but they are also diversified into other segments of the market. So they produce and distribute different diversified technology and manufacturing goods across the world, and they've actually used this pandemic to their benefit. The Honeywell CEO says this company has actually been changing because of the pandemic and use it as a springboard to move forward in a more diversified and more efficient manner. So I really like it when companies come out and use a bad time in the market to actually improve operations, and Honeywell CEO says they are doing just that. So this is a play on the aerospace industry, but it isn't a direct play. It allows you exposure to that market because they, of course, produce components for planes and other aspects of the aerospace and travel industry, but it also allows you to be a little bit more safe because they also have diversified revenue streams and other business segments that remain operational even throughout the pandemic. So this is a dividend-paying company, currently yielding 1.82%. They only pay out around 53% of their earnings, so a very sustainable payout ratio, and they've been growing that dividend at a nice rate, averaging over 13% annual dividend growth rate, which I believe is very strong, and I think they can continue that moving forward. Number 3, I chose out of the retail sector, and I chose the company Target. This is a dividend king. They are up close to 40% on the 1-year chart, and I think this is a company that's only going to expand once we return to normal. People really enjoy shopping at Target. They have one of the highest consumer spending ratings. People really enjoy the atmosphere of their stores, the design of the layout, and I think this is a company that once people return back to physical retail, they will continue to grow, and a lot of small businesses will not remain operational, but Target will. And worst case, if the pandemic does continue throughout 2021, they remain open. Target stores are allowed to remain operational because they provide necessities to consumers. So no matter what goes on, whether we see a recovery back to normal or the pandemic continues, I think Target's still going to be a strong company to own, especially entering this week in the market where we have a lot of Black Friday sales and into December and where the holiday season picks up. This time for shopping and retail, I think, is only going to grow, and I don't think we see Target declining anytime soon. So although they are up pretty high right now, it may be the best chance to buy this share before they continue to grow past this point. They have a market cap at around $86 billion and pay a dividend yield at 1.53% and trade at a forward PE of 19.7. So of course, with this dividend yield of 1.5%, it is on the low side, but the dividend is very sustainable. They only pay out around 30% of their earnings. So the company retains a lot of money to grow operations, continue to grow that top line revenue each and every year and expand, which is exactly what we want to see. And tied in with the share price growth we get from Target, this is actually a sustainable company that gives you a nice overall return of a combination of share price growth and that slightly small dividend at 1.5% that is growing averaged around 6.4% per year. They are a dividend king, proven to increase their dividend through good and bad times, another retailer where once the vaccine comes out, people feel more confident shopping in person. I think this will be one of the brands that will survive and continue to grow. Moving on, we have stock number 4, which I chose out of the travel sector, which is Disney. So Cramer lists all the cruise lines and Disney within this sector of the market from his long list. And I picked Disney as the winner, currently trading around $151 per share. They are only down 1.5% on the 12-month chart and have actually seen a nice recovery as of late. They trade at a market cap of $263 billion and a forward PE of 66, and they have suspended their dividend as of late, so they do not pay out a dividend right now. But I think Disney is a company that will continue to grow moving forward because they understand where the growth comes. Their Disney Plus subscription numbers are insane. Over 73 million paid subscribers, and they have over 100 million paid subscribers for all of their streaming services combined. So they have a massive digital and streaming platforms that are only expected to grow at another massive rate over the next 3 to 5 years. And I think Disney has done a great job because they announced a transition for their entertainment services. They're going to put more focus into the streaming platforms. They know that's where the money is. They know that's where the future growth is going to be. And they have made that change within the organization to focus and prioritize that aspect of the business, which really reassures me as an investor that they know where the strong future outlook is and they're going to put money towards growing in that sphere. And of course, some other good news is that they've actually started to begin to reopen their California theme parks. So the theme park itself is still remained closed, but they opened it for shopping and dining, which is a good sign. At least they're getting some foot traffic into the park. At least it's getting people the idea that Disney is still there. It reminds them that, the parks are still around, and soon, one day, once we return to normal, if these vaccine news can come out and it is safe to have thousands of people within the same theme park, Disney will reopen, and these theme parks did bring in a ton of revenue that was essentially lost throughout 2020, but can rebound very strong throughout 2021 if they are allowed to remain operational and open back up. So I think Disney is a company that still has a lot of upside. Although people may say it's overvalued right now, of course, you can't buy a company looking back. We can't go back to these prices. If only we knew the future of Disney Plus and the streaming services back in the month of March when they were trading at $85, but we didn't have that information. Now we have the headlines from their latest report that the streaming service is doing better than ever, growing at a massive rate. and they're going to prioritize that for the future. I think Disney is a travel company that can expand moving forward because they're doing more than one thing. If they were solely focused on the theme parks and getting those back up, then I'd be a little bit worried. But the fact that they're going to have the theme parks back and operational very soon, and the streaming services, a well-diversified company that can grow moving forward. On to number 5, we have Tesla. Cramer lists about 5 different auto companies on his larger list, and I chose Tesla as the winner that we're going to go over today. And that is because Tesla is much more than a car manufacturer. The company is up over 683% on the 1-year chart, and they have now crossed a market cap over $500 billion. They're the first ever auto manufacturer to have a market cap back in January of $100 billion. And less than a year later, they have crossed the $500 billion mark after insane performance on the 12-month chart. So this company is much more than an EV car manufacturer. They have other network services, other infotainment, and other parts of their business and ecosystem that are really going to help them drive forward. Their first-class systems is really what's going to set them apart. Their software, their hardware, of course, the vehicles, is a great part of their business. But like I went over in a previous video earlier this week, Morningstar believes that the actual car manufacturing part of Tesla's business will only make up around 45% of their value. And the remaining 55% is going to come from their other services, such as their supercharger network, their Tesla insurance, the ride-hauling platforms, the other services like the solar roofs. The expansion of their business is much more than just car sales and car products, and I think it's really going to help them grow over the long term, and I think they will remain as one of the world's most valuable companies over the next decade. Now if we move over to stock number 6, this is ticker MCK. Currently trading around $180 per share, and this was chosen out of the vaccine distribution sector from Cramer's list, and this was actually the only one he listed for that sector of the market, so I had to choose them, and I understand why Cramer made that pick. So they are up around 13% this year and trade at a market cap of around $27 billion with a forward PE of 10.59. So this company is huge upside potential moving forward. A lot of articles right now, literally dated this week, show that you should buy the dip in this company because they have potential 25% growth moving forward. They have strong operating growth, and of course they've actually landed on Goldman Sachs' buy list right now because they believe the presence of the distribution and of the wholesale pharmaceutical sector is only going to grow, and there aren't really main competitors to continue and actually compete with this brand moving forward. And as we have a national vaccine that's going to be distributed across the nation and throughout North America, this is going to be a major player in that distribution network. So this is a dividend-paying company. They currently yield around 1% right now with a payout ratio of only 10% of their earnings. Their payout ratio is nothing. Most of the money is staying back within the business to grow and improve operations, and they only pay out around 10%. So the dividend is extremely, extremely safe. No worried about a dividend cut coming anytime soon. If we take a look at the dividend history, the companies continue to perform very nicely, raising the dividend over the past decade each and every year, and a nice, long, consistent dividend growth streak. So of course, with this dividend, it only pays out 10% of their earnings. They grow it at around 10% per year, and I believe that will continue to happen nicely moving forward. The final stock on our list is Darden Restaurants, ticker DRI. So Cramer listed a bunch of different restaurants that he believes are going to grow. The two main ones were Texas Roadhouse and DRI, Darden Restaurants. And why I chose DRI is because they're diversified. They have many different brands. And if we take a look, they own over 1,800 restaurants. One of their main and most popular brands, of course, is the Olive Garden. They have Longhorn Steakhouse, Cheddar's Scratch Chicken, and many more. So as restaurants begin to reopen, as we return to a sense of normalcy, once people feel comfortable going to eat out at a restaurant, I believe the restaurant industry is going to flourish once we hit that point. We don't know exactly when we're going to get there, but I believe when we do, all the people have been cooped up in their homes for over a year now. The people have been staying home, not eating out, not getting out of their house. I just think going out to a restaurant, once it's safe, is going to be the go-to activity, and I think Olive Garden is at the right price point. It's not super high-end, but it's not also super cheap. I believe they're in the right sector of the market that's going to grow once people feel comfortable leaving their homes, and I think this company will be able to grow moving forward, and I understand why Cramer put this as one of the picks in the restaurant industry. So those are the picks from Cramer's list. If we take a look, he listed a ton of companies. He gave over 20 different names on this list, and I went through and picked 7, one from each sector that I believe is going to grow. So you can see as we just do a quick overview, we went through the aerospace, the retail, of course, the vaccine distribution, travel, restaurants, and autos, and even financials. So the Cramer gave a nice, diversified list. He has a wide audience that has to kind of suit their needs as well. He's going to give more than a few options within each sector, but I like going through picking the winners within that list from Cramer's overall, analysis of the market. And that's what we did today. So please hit that like button and subscribe. See you in tomorrow's video.